Welcome to the monthly 3-Edge View from the Edge for October 2024. I'm Fritz, the Chief Investment Strategist here at 3-Edge, and joining me here once again today is Eric Biegeleisen, Director of Investment Research and Deputy Chief Investment Officer here at 3-Edge Asset Management. And as we do each month, Eric and I will provide our most recent outlook for the global capital markets based on our proprietary research model. And as we enter the fourth quarter of 2024, there's certainly a lot going on in the world that could impact the direction of markets. As we know, last month the Fed began to lower short-term interest rates. And up to this point, it seems that the Fed Chair Powell has convinced investors that the 50 basis point cut in rates last month was preemptive in nature and not a response to deteriorating economy or labor market. And the resilience of the labor market was supported recently by the monthly jobs report for September, which showed that non-farm payrolls increased the most in the past 6 months, and the unemployment rate fell to 4.1%. However, after a strong jobs report a few weeks ago, this week we saw another report which showed a sharp increase in jobless claims. On Thursday of this past week, we also got the Consumer Price Index report, the CPI, for September, which came in higher than expected at 2.4% year over year. But the number was still a slight decrease from August's reading of 2.5%. Then yesterday, there was yet another report on inflation, which showed that inflation at the wholesale level, which is the PPI, Producer Price Index, was unchanged from the prior month. And, so it's well behaved in that regard. And then lastly, of course, yesterday, Friday, marked the beginning of the third quarter corporate earnings season. And so investors will be focused on both the third quarter profits and the forward guidance for Q4 and beyond. So what we're seeing, to me, the most recent data on both the strength of the economy and the labor market, as well as the path of inflation, are decidedly mixed. So it's a bit of a challenge for investors and the Fed, since they always say that they're data dependent. So let me bring Eric into the conversation and see if we can get some clarity from our most recent outlook. And let's dig into our 3-Edge asset class matrix and see what has changed since the prior month. So over to you, Eric.
Thanks, Fritz. Not a lot of movement here. We see the notable arrow there is the EM China moving from that -1 slot up to the +1 slot. Still favoring U.S. equities, but on watch. Similar with Indian equities, favorable, but kind of on watch there. Europe and developed Asia still holding in that -1 spot. Rates a bit more neutral. We're still favoring short-term fixed income and cash, as we have for some time. Credit still somewhat unattractive. And hard assets, both gold and commodities, maintaining that favorable +1 spot.
So not a lot of change from the prior month, but let's dig in here and with the equity markets and the equity asset classes. And why don't we start with U.S. equities?
Yep. Yeah. So the model research does remain positive, but it is cautious. So in terms of the current outlook for U.S. equities, we've seen this past week the S&P 500 reach yet another all-time high. And while still highly overvalued by our measure, the economic and the investor behavioral factors just continue to indicate a somewhat positive outlook for U.S. equities, at least here in the near term. We've seen declining short-term yields, which is supportive of U.S. equities from the Fed's, the monetary policy, lowering rates. But we've also seen longer-term yields. They've risen recently, and that's become what was much more of a positive factor has become much more of a muted factor, a neutral factor for U.S. equities. So losing a little bit of that positive outlook just from that one factor alone. That said, like we said, reaching all-time highs brings along positive investor psychology, and that remains a positive factor, though just not as positive as it was even just a month ago. So positive, but on watch.
Okay, excellent. So let's take a look. Let's venture outside the U.S., ex-U.S. equity markets, and why don't we start with Europe?
Yeah, the research is showing largely just a sea of negative factors, which are heavily outweighing the few positives that are present. All that said, the potential for a breakout to all-time highs is possible. That could shift investor psychology to a more positive footing, which could give a more positive outlook. But for the time being, the inverted yield curve measure that we calculate for the region is weighing negatively on the outlook. And despite the ECB, the European Central Bank's monetary loosening, shifting the yield curve measures like turning a cruise ship. So it may take some time for, that change in interest rate policy to shift this impact of this factor to a more positive outlook.
All right, so let's move now over to Asia and look at Japanese equity market.
Yeah, I mean, Japanese equities have been on a bit of a roller coaster ride in the third quarter, selling off in early August by over 10% before finishing the month up just 1%, then declining again in early September before climbing back by the end. Alongside this, we've seen the Bank of Japan give signals that more monetary tightening is on the way, but then they've just more recently held off. So there's a lot of volatility there, and Japanese equities maintain a negative outlook while there's that uncertainty remains.
All right, so now let's turn our attention to emerging markets in China. What is our outlook there for China and the emerging market?
Yeah, that's the big move this month on the asset class matrix, and it feels like we've been waiting for a large stimulus package from the Chinese government for some time, and it's arrived. They announced a number of stimulative monetary and fiscal measures. This includes reductions in the reserve rate, requirement ratio, and policy interest rates, measures to support the real estate sector, including cuts to mortgage rates and down payment ratios, and new financial market tools as well that have been introduced for liquidity support, programs to help companies buy back stock. So they've done a lot here. And the immediate result was a dramatic spike upward in Chinese equities, which had struggled throughout the year. Flat, actually. Through mid-September on the year, Chinese equities were flat. And then they peaked up at around up 47% on the year. You can believe it, through early October, right? I mean, incredible. Then recently, investors kind of decided, well, maybe this stimulus isn't enough, actually. So they gave back some of those gains, still up around 28% on the year. And early indicators out this morning suggest that the government may announce additional stimulus measures this weekend. So we'll keep an eye on that. The model research is positive on emerging market equities broadly, as the Fed has begun to ease monetary policy here in the U.S. by lowering rates. That's helpful for the outlook for China and emerging market equities more broadly, which often benefit from a weakening dollar and which we may see more of in the months ahead. So we'll move to a positive outlook here.
Excellent, thank you. The last equity asset class is going to be India. So what are we seeing there?
Yeah, the long-term growth outlook remains positive. The near-term outlook is a bit more mixed. We've seen several months of widening credit spread measures that we focus on, so that's a bit concerning. A pause in some of the equity market momentum that we've been watching, and a change in the slope of the yield curve has generated a little bit of short-term concern for that outlook, but still net favorable right now, but like the U.S., on watch.
All right. How about the bond market, the interest rate environment, starting with the U.S. Treasury market now? I believe the 10-year is up over 4%. I don't know if it held that, but what are we looking at when we see what's the U.S. Treasury market look like here?
Yeah, the 10-year is up at 4.1 as of this morning. U.S. Treasury yields have declined, but the yields on the longer dated Treasuries have ticked higher, like we just said. Continued declines would be helpful for bond investors, though it's not clear how much more of a decline we should expect to see from here in the near term. With the potential for additional rate cuts by the Fed, and as we just discussed, the dollar may decline in value, and that could put upward pressure on yields even further than we've seen. So as we've said for many months now, shorter maturities continue to provide more attractive yields and remain a better risk-adjusted position on the yield curve.
All right, and then let's shift slightly into the corporate bond market, or sometimes referred to as the credit markets. What's the model indicating there?
Yeah, not much change here. The inversion of the U.S. yield curve, which has been in place for quite some time, signals the potential for an economic slowdown, though that hasn't necessarily materialized. And that's just not at all reflected in the current level of corporate credit spreads, which do remain quite tight. So, given the level of risk one takes on for investing in corporate credit versus the spread over treasuries, just does not seem worth that trade right now. So the outlook remains cautious.
All right, so now we'll shift into the hard asset category, gold and commodities. And why don't we begin with gold, which continues to outperform the S&P 500 this year?
Yeah, gold has been one of the best performing asset classes year to date. The outlook does remain favorable due to, continued geopolitical conflicts on multiple fronts that we're all aware of, a potentially weakening dollar, like we talked about, excessive federal debt levels. There is shorter term concern of some profit taking, just given the recent strong rally that we've seen at these new high levels. But the prospect for continued declines in real interest rates, that is inflation adjusted, that could be very supportive for continued gains in gold. So still favorable.
So a quick follow-up question on gold, if you don't mind. So has the investor behavior factor, is that not quite as positive as it was? I sort of interpret that from what you're saying.
Yeah, I think less so. Gold has continued to make new highs, and every time it makes a new high, there's the potential for other investors on the sidelines to see that and get involved and get invested. And so, gold it had been making out to new highs, and maybe it stalled out a little bit here in the mid 2600 region. So, you'd want to really see that climb up over 2700 to really excite investors and perhaps, attract new assets.
Okay, great. Thank you. Commodities. What are we seeing there in terms of the commodities market?
Yeah, well, the combination of what's anticipated to be a series of rate cuts by the Fed, China's announcement that we just discussed of that monetary and fiscal stimulus, and the conflicts in the Middle East, which has already served to drive oil prices higher and could certainly do a lot more. That all continues to be supportive of higher commodity prices in the months ahead. So, it remains a positive asset class for us.
All right, good. That's a wrap. Thank you, Eric, for updating our outlook and providing for us those factors that are in the model which help us understand the outlook going forward from here. So that will do it for this month's 3 Edge View from the Edge. Eric and I will be back again in November. I can't believe it's already November, with another edition of the monthly 3 Edge View from the Edge. If you'd like a hard copy of the full View from the Edge newsletter for the month, you'll find that on our website at the number 3edgeam.com. And as a reminder, all our videos are available on our 3 Edge YouTube channel. If you think someone you know might benefit from them, also please feel free to share them. Also, if you appreciate these weekly videos and would be so kind to subscribe to our 3 Edge YouTube channel, we would be appreciative. Lastly, a reminder that next Tuesday, October 15th, Steve Cucchiaro and I will be presenting our 3 Edge quarterly webinar, and that is at 12:15 p.m. Eastern Time. We'll review the third quarter, provide our detailed market outlook for Q4 and beyond. If you'd like to join that webinar next week, you can reach out to us here at 3 Edge. Just send us an email to info@3edgeam.com. So, on behalf of Eric and everyone here at 3 Edge, thanks for listening.